Hello. Welcome to our next chapter. Very important chapter. That is your taxation of trust. So I have tried to summarize it as much as possible. So first of all, let's understand what do you understand by trust. So under trust, there is charitable activities. So they have defined charitable activities as relief to poor, education, yoga, medical relief, preservation of monuments, and environment. All of this will be considered under charitable. Now, section 11 says that the following income of trust will be exempt. Which incomes? First is your corpus donation. What is your corpus donation? Corpus donation is similar to what capital for a company. That is, this is your main income. This is your capital. So corpus donation, if a trust receives any corpus donation, this will not be taxable because this is not considered as income itself. Even if it is received in cash and only if it is deposited in safe investment, that is, even if they have received it in cash, even if they have received corpus donation in cash, it will still be exempt. But they have to invest this in safe deposits. They have to deposit this in safe investments. Only and only if they deposit this amount in safe investments will this amount be considered as exempt. Okay, now next is your 15% of gross income. 15% of gross income means your gross receipts, whatever receipts you get minus expenses, this amounts 15% will be exempt. So there is a lot of confusion in the market regarding 15% of gross receipts, or is it 15% of gross receipts minus expenses. So usually the view is taken that it is 15% after subtracting, that is 15% of gross receipts minus expenses. The remaining 85% income will be applied in India for charitable or religious person. That is, the 15% is already exempt. Now the remaining 85% only and only if it is applied for charitable purpose and India, you have to remember it has to be applied in India. That is, if you have applied outside India, if you have applied abroad, that will not be considered as exempt. So only and only if this is applied in India for charitable or religious purpose. Charitable, we have already defined what charitable is. Only in such a case, this rest remaining 85% will also be considered exempt. Clear? Got it. Now next is what is considered to be applied, because we said that your income should have been applied. Now what does apply mean? So any capital expense plus any revenue expense will be considered as applied. Now remember, if we have allowed your entire capital expense as a deduction, what you have to remember is, of course, you will not be getting any depreciation on this, because the depreciation the depreciation that you get over parts as deduction throughout the years, they said that boss, you take the whole amount as you take the whole capital expense as a deduction. So this will be considered as applied. So that means your capital expense and your revenue expense both will be considered as applied. Second is your applied will be any donation to another trust registered under section 12AA or 12AB. So if you have donated to any other trust under section 12AA or 12AB, this income will be deemed to be applied. Next is it will be applied if repayment of loan taken for acquisition of capital asset. If you took a loan, if you took a loan to buy a capital asset and now you are paying back this loan. So since you are paying back this loan, it is as good as you spent money to buy an asset. So only and only when you repay this loan that you are taken to acquire this asset, will this amount be treated as your applied. Okay, so repayment of loan taken for acquisition of capital asset. You have taken a loan and now you are repaying the loan back, so it will be treated as applied. In this case, it will not be treated as applied if corpus donation to another trust. So over here, you remember we read donation to another trust. So if you are donating to another trust, it will be deemed to be applied, but it cannot be a corpus donation, because what would happen if I was allowed corpus donation as applied? I would give it to another trust, and your other trust for we have already studied that corpus donation is exempt. Therefore it will become exempt for me and exempt for them as well. So trust would misuse this provision. Therefore corpus donation to another trust will not be treated as applied. Next is it will not be considered as applied to the extent of 30%. You guessed it right, 30%. Whenever the limit comes, it is definitely related to TDS. So it will not be considered applied to the extent of 30%. That means, for example, if you have made a payment of 10,000 and you forgot to deduct TDS, then 3,000 will not be considered as applied, and your rest 7,000 will be considered as applied. So 30% portion will not be applied if TDS is not deducted, or TDS has been deducted but not paid to government. So that means you either forgot to deduct TDS itself, or you deducted TDS but you forgot to pay to the government. In such a case, 30% of your amount will not be considered as applied. Your next portion is any cash payment exceeding 10,000 in a day. So if you have made any cash payment which exceeds more than 10,000 per day, in such a case, this amount will not be treated as applied. So you have to remember this is not applied. Next is it will not be considered applied on incurring expenditure out of a loan taken which has already been treated as applied. So if you are incurring if you took a loan and out of this loan now you are incurring expenditure, this will not be treated as applied because it is out of the loan, it is not out of the income that you have received. This will be treated as applied only and only when you repay the loan. So this point is similar to your this point that we studied, that is repayment of loan taken for acquisition of assets. So only at the time of repayment will this be treated as applied. So it will not be treated as applied on incurring expenditure out of a loan taken. It will be treated as applied when loan will be repaid. So I hope this is clear to you. And your last is it will not be considered as applied if applied out of corpus fund, because your corpus fund was never taxed itself. It is exempt from the very start. So if you are expending something from your corpus fund, it will not be treated as applied. I hope the logic is clear. You don't have to learn these things. You understand this logically, that why they are making something exempt and why they are making something taxable, why they are treating something as applied and why they are treating not applied. Okay. Now your next point is any excess application. Any excess application means, for example, your income was 100 and during the year you applied 120. So now this 20, you will not be allowed to be carried forward. That was this 20 I will use next year. Next year if my income is 100, I only need to spend 80 and this 20 I can use this year. No, this is not allowed. That means that whatever expense, whatever application you have done in that year, that is done and dusted, that is over. So any excess application not allowed to be carry forwarded to the next year. Okay. Next is any income accrued not received will be treated as income when received. That is, if any income has been accrued, that is, for example, you have earned any interest, you have earned any income, but you have not received it in hand, either in the form of bank, cash, or any other way. You have not received this income. So it will be treated as income for the tax purpose only when you receive it in hand. Accrual will not be taxed. Next is if income is received but 85% has not been applied, that is you have received the income but 85% of the portion you were not able to apply, because look, 15% is already exempt. But if the remaining 85% you were not able to apply, then submit a declaration to your assessing officer up to the due date of return filing, that this remaining amount that you were not able to apply, that it will be used in the next year. Such income will be deemed to be applied in the current year. So you are making a promise that, boss, I will for sure promise, pinky promise, I will be using this income next year. Please don't tax me this year. So therefore, this income will be deemed to be applied for this year. They will not tax you, but you will have to use this income in your next year. Got it? Next point is I'll erase this so that it is easier to understand. Okay. So your next point is income can be set aside for a purpose for accumulation for maximum 5 years. Okay, now what if I have to do any capital expenditure? I require some huge sum of money. So what I can do is I can set aside some income for a period of total of 5 years. I can set aside income each year and it will not be taxed. So income can be set aside for a purpose for accumulation for maximum 5 years. It will be taxable. This income will become taxable when, if it is used for any other purpose. If I said that, boss, I need this amount for renovation of my temple, and if I use it for any other purpose, in such a case this amount will now become, it will now be taxable, because earlier they did not tax me. If it is not used within the period, if I have not used this amount within the 5 year period, then it will become taxable. If I have not deposited in the safe investment, I have to deposit this income in my safe investment, only then will I get the exemption, otherwise they will tax And if the ROI is not filed up to due date, if I missed filing the ROI by due date, this income will become taxable. So basically, you have to satisfy four conditions so that you can set aside for a period of 5 years. Now your next point, it is compulsory to file return if your NTI is more than your basic exemption before claiming this exemption. This exemption, that is the trust that benefit that you receive. If your NTI is more than your basic exemption, then it is compulsory to file return. If the trust carries out business which is incidental to the main objective, can claim exemption for such income. That is, if the trust carries out business which is similar, which is related to my main objective, in such a case they can claim exemption. It is not your income tax officer cannot say, boss, you are also doing any other activity. This is not covered under charitable, therefore I will not allow you this. So even if it is incidental, it will be allowed. Now there is a amendment here. If a trust has temple, mosque, church, etc., and it has received any donation for repair, so all of these are your temples. So if they receive donation for repair, this can be treated as corpus. That is, this donation that they have received for doing repairs, it will be treated as corpus. If amount is utilized for repair or renovation, amount is not donated to any other person and it is deposited in my safe investments, in such a case, this income that I receive, it will be treated as corpus and it will not be taxed because corpus donation is exempt. Okay, now coming to your important point with regards to registration. So with regards to registration, you will have to obtain registration under section 12AB with effect from 1st April 2021. So if you want to get these benefits, if you want to be registered as a trust, you have to get registered under section 12AB before 1st April 2021. 1st April is my birthday. So if you're watching this video on 1st April, do comment on the video. So next is, so there are some cases when you have to make application, when you will, so our table goes like, there are some cases when you have to make the application, when you will be granted registration, what will be your period of registration, and the year from which your exemption will be granted. So if you are already registered under section 12A, if you are already a registered trust under section 12A, you have to make an application 3 months from date and so that is from when it is applicable. So you have to make it within 3 months from 1st April 21. When will your registration be granted? It will be granted 3 months from end of month of application. That is, whenever you make an application here, go to the end of the month and from that date it will be 3 months. So EOM stands for end of month. Your period of registration, that is for how long do you get this registration for, that is your 5 years. And year from which exemption granted, it will be assessment year from when earlier granted registration. Okay, so that means from when you have already been granted registration, that will only be continued. So this point is done. If your next is your new trust applying for fresh registration, if you are a new trust applying for registration for the first time, it will be 1 month prior to the start of the previous year. That is, whichever year you need your registration from, you need to make an application at least 1 month prior from the start of that previous year. When will the registration be granted? It will be 1 month from end of month of application. So remember, over here it is 3 months. So over here also it is 3 months. Over here it is 1 month. Over here also it is 1 month. Your period of registration will be 3 years. You will be getting a provisional registration, and it will be from assessment year relevant to financial year in which application has been made. Now your next is your trust granted provisional registration. Now applying for final registration. Over here, you got a provisional registration, right? So if you received a provisional registration and now you want a final registration, so you have to make an application earlier of 6 months from prior of expiry of approval. That is, whenever your 3 years get over. So expiry of approval or 6 months from start of activity, that is from when you are going to start activity, 6 months from start of activity, whichever is earlier. Your grant of registration will be 6 months from end of month from application. So it is very easy to remember: 3 months, 3 months, 1 month, 1 month, 6 months, 6 months. Period of registration will be 5 years from date of provisional registration. Okay, so that is 3 years plus you might get more 2 years over here, so it becomes your total 5 years. from first assessment year for which it was granted provisional registration. And if your trust is registered under section 12AB, so you have to give 6 months prior from expiry of registration, because this registration is under section 12AB. So if it was already trust registered under 12AB, so 6 months prior from expiry of registration, again your grant of registration is same 6 months, period of registration is 5 years, and it is from assessment year relevant to financial year in which application was made. That is the period from which exemption is been granted. Okay. If your trust applies income for benefit of specified person, that is, if it applies it income for any specific person, for any relative of its, in such a case, FMV of such facility will be added to the trust income. That is your fair market value of whatever facility you are giving, whatever special facility you are giving to the relative person, that will be added to the trust income. Of course, it will not be allowed as applied, but instead it will furthermore be added to your income. So remember, it is not that first it is treated as applied and then added back, so nullifying the effect. It is not that way. You will not be treated as applied, and plus it will even further be added back. Next is when capital asset is transferred and net consideration is used to buy another capital asset. That is, if one capital asset you have sold and using these proceedings you are buying another capital asset, in such a case your capital gain will be exempt up to. So if your net sale consideration is fully utilized, for example, if you sold the asset for 100 rupees and you bought your new asset for 120 rupees, so now this 100 rupees has been fully utilized, correct? So your full capital gain will be exempt. That means, for example, if you sold the asset for 100 rupees and you had purchased this asset for 30 rupees, now your capital gain would be how much? 70. So if you utilize, if the new asset that you purchase is for more than 70 rupees, that is, if the net sale consideration is fully utilized, if you have purchased your asset for more than 100 rupees, that is the amount that you sold it for. If you have if you have used the entire amount, then your full capital gain will be exempt. However, if net sale consideration is partly utilized, that is, your asset was for 100, you sold your asset for 100, purchased it for 30, 70 is your capital gain. If instead of 100 you are spending anything less than 100, then your cost of new asset minus cost of old asset is exempt. That is, how much amount you spent on your new asset minus cost of old asset, only that portion of your capital gain will be exempt, the rest will become taxable. Trust has to register every 5 years. If trust has not registered in 12AB, it will be treated as AOP BOI and taxed at your uh, maximum marginal rate. So if you remember, it was a 44 point something percent as we studied in your AOP BOI. Okay, next is income of university, educational institution, hospital will be exempt if government grant is more than 50%. Okay, so in such a case, it will be exempt and there is no need for registration. And income of university, educational institution will be exempt if gross receipt is up to 5 crore. If gross receipt is up to 5 crore or government grants is more than 50%, your income will be exempt and there is no need for registration. Okay, so I hope these points are clear. Following incomes are taxable at 30%. So any incomes accumulated in excess of 15%, this will be taxed at 30%. Income used for any purpose outside India, if you use the income for purpose outside India, we will tax it at 30%. Income applied for the benefit of specified person, over here as we had studied, if you apply any income for the benefit of any specified person, this will be taxed at 30%. And any income not deposited in safe investment, if you did not deposit the income in safe investment, it will be taxed at 30%. Okay, so these are your four cases where income will be taxed at 30%. Otherwise, it is usually at slab rate. Okay, now next is income. So now red means this you have to exclude, this you have to subtract from income. This does not form part of your income. Red means does not form part of your income. Green means form part of your income. So any corpus donation, anonymous donation which is taxed at 30%, you have to exclude this. You have to subtract this from your income. Which income? Corpus donation, anonymous donation which is taxed at 30%. Only that portion you have to subtract from here. Okay. And what things do you have to include? Grants. minus capital gain. Anonymous donation within limit. These all you have to include. Okay, so only anonymous donation which is taxed at 30% that we will be subtracting. So this is your format. This is your income. Then you subtract 15% standard deduction that I have told you. Then you subtract anything applied for trust purpose. Anything that has been deemed to be applied. So either applied or deemed to be applied, both of these will be subtracted. Any income that you have accumulated for specific purpose, or which we have studied for 5 years, you can accumulate this, you can subtract. And any income which you received in the month of March, because you do not get time only to spend this money, therefore any income that you received in March will also be subtracted. Now this income will be taxable at slab rate. I hope this part is clear. Okay, now sir, what is my anonymous donation? How do you tax anonymous donation? So for anonymous donation, you have to calculate anonymous donation greater than higher of 5% of total donation. What you have to remember over here, in total donation you have to take corpus also, that is everything, all the donation that you have received, you will calculate 5% of that. Then you will calculate 1 lakh, whichever of these two is higher. 5% of my total donation including corpus donation and 1 lakh, whichever is higher, that portion will be taxed at 30%. So for example, if my anonymous donation was suppose say 1,30,000, okay, and for example, my 5%, 1,30,000 was my total donation. So using this formula, my amount comes to 1 lakh. So this means anything 1 lakh, anonymous donations greater than 1 lakh will be taxed at 30%. So that means 30,000 in this case will be taxed at 30% and 1 lakh will be taxed at my normal slab rate. I hope this is clear. Anonymous donation greater than higher of these two. So over here our limit was 1 lakh. So anything greater than 1 lakh will be taxed at 30% and 1 lakh will be taxed at your normal slab rate. Great. This is clear. So this we are done with trust, and let's go on to exit tax, or that is tax on accredited income. So for your exit tax, yes, so exit tax. So whenever trust registered under section 12 AB, if it converts into such a form, if it converts to any company, any partnership form, for example, anything, or it does not carry out any charitable activities, it does not come under the definition of section 12 AB. In such a case, we will be taxing all his assets, all its net worth at some rate. So when a trust registered under section 12 AB converts into a firm not eligible under section 12 AB, accredited income will be taxable. That is, this is also called exit tax. This will be taxed at your maximum marginal rate of 34.944%. How do you calculate this? 30% plus 12% your surcharge plus 4% your health and education tax. So you will tax this at 34.944% within 14 days. Else there will be interest at 1% from day 15. So therefore, this tax you have to pay within 14 days. From 15th day onwards, there will be a 1% interest. Accredited income. What is my accredited income? Now your accredited income, how do you calculate? You will be calculating using this formula. Accredited income is equal to fair market value of assets. That is all the assets that you purchased after registration. Now sir, why after registration? Because before registration you did not get any benefit of this section, right? So only the assets that you purchased after getting registered, that is all the assets that you have taken benefit on. Your fair market value of these assets minus your total liability. Fair market value of assets minus your total liability, basically this is nothing but your net worth. So your net worth will be taxable. Your following assets and liabilities do not have to be included while calculating net worth. Which do not have to be included? So first is assets acquired out of agriculture income, because agriculture income itself is exempt. Any assets acquired by trust during period from date of creation of trust to date of registration. That means assets that were purchased before registration, because you did not get any benefit on these, you will not be including this for the purpose of accredited income. Next is any asset transfer on dissolution to another trust within 12 months from end of month in which dissolution takes place. If you transferred any asset to another trust before dissolution, that is before converting to such a entity within 12 months. So during the last 12 months, these will not be considered and these will be added to your assets value. Okay, now your fair market value of assets. What do you mean by fair market value of assets? Because over here we have used the word fair market value of assets. So, sir, what do you mean by fair market value of assets? So for quoted shares and securities, if your shares and securities are quoted, that means they are listed. It will be average of highest and lowest price on valuation date. It will become the average of whatever the highest and the lowest price that it was traded on the valuation date. So this is for shares and securities, and for land, it will be higher of market value and SDV, whichever is higher. That will be your fair market value for land. And with this, we are done with your taxation of trust as well as your accredited income. Anything you need to add? I have left some space for you so that you are free to add. And I will meet you in the next chapter, that is clubbing of income.